Hi, and welcome to the CostofCarry podcast. My name is James Chi. Let's get into it. An interesting point is the role of storytelling. Now, storytelling doesn't mean creating a piece of fiction using the facts, or making this is based on a true story type of situation. Storytelling and creating the narrative means painting the picture to the information that is in the application. And for those of you who have done an application before or who have been involved in filling out an application, will understand that there is a lot of back office work that goes into it. And by that same token, there is a lot of grunt work on the behalf of the lender in assessing that loan as well. While some of this work can be automated and done digitally, at the end of the day, it still needs to be overlooked by a human, and there's no way of cutting corners, or there shouldn't be any excuse for cutting corners in this part. All participants need to take the appropriate steps and due care and processes in making sure that the loan is compliant as well as useful. And so what the role of storytelling is providing a summary to the application so that the credit assessor understands what they're looking at. And so, for example, going back to the example of being a self-employed business owner who's just started up a business, being able to storytell the growth of the business, the industry, what it's experienced, and why the financial figures have changed over the past 2 years or last year is important in making sure that the application makes sense for what the purpose of the loan is. So, for example, if you want to refinance your home loan and take out an additional $50,000 for your business, the way that storytelling fits into it is that you would explain how the applicant is a self-employed business owner. They are in the period of expanding their startup business. Over the course of the last 2 years, the business has undergone some dramatic change, and this has produced many great benefits. And to continue that success and expansion of the business owner or applicant requires an additional sum of money to ensure that they can deliver on the contracts and the inventory that they have committed to, as well as ensure that there is a buffer available to also respond to any unforeseen changes that have been listed in the business plan that has been also provided or summarized in the application. So storytelling can be a very important part of the application, maybe not so much for vanilla type of deals, but for more complex type of lending scenarios, storytelling is very important. The broker is working for you, and two-way transparency is required. The reason why this is interesting is that there's a perception in the market that sometimes financial professionals are working in their self-interest only, rather than for their clients or for the greater community or towards their industry body. I wouldn't say that's completely false. There is a bit of truth behind it, and there are examples of it occurring in the marketplace. Obviously, there's been a bit of greed, there's been a bit of fraud and corruption and insider trading, and none of that is good for the industry. However, for those brokers and industry professionals who do the right thing, the way that the client can help them make their jobs easier and deliver a better performance is by also displaying the same qualities of transparency, professionalism, respect, and understanding. And the reason why this helps is because without the right information or without the right motivations behind the application or behind the financial lend, the broker won't be able to convince or wholeheartedly back the application that they're writing under their own name. And the worst thing that a broker can do the worst thing that could probably happen to a broker is submit an application, get it to conditional approval, and then find out additional information which jeopardizes the application for their client. For example, this may include they have an outstanding ATO debt that wasn't disclosed on the application, and that clearly affects whether or not it can be a prime or a near prime deal. Similarly, the application omits details relating to jointly held debts. Furthermore, the application could omit that the applicant has just been made redundant between the period from client interview to time of submission of the application. Not only does it create a little bit of confusion in the loan process for the customer, but it also creates a bit of frustration on behalf of the broker, because there is a bit of rework that needs to get done. So this could mean you either need to redo an application and send it to a different lender, because with the new information that's been provided, the lender just now doesn't feel comfortable in doing the loan. Or it can mean there is a slight adjustment to the loan, but that still entails a bit more critical assessment from the lender on the character of the borrowers. So it's important for there to be a two-way understanding of transparency in the loan process, and this will undoubtedly help the timeliness and speed of the loan. With the more information that the broker has access to, the greater their ability to storytell, as well as the greater their ability to narrow down the best solutions possible. Because without the right information, and this is something that's universal to all industries, without the right information, it's hard for us and hard for professionals to do their job properly. And this doesn't mean that having less information means it can be quick, the job can be done quicker, or it can be done in a deceiving manner. Having the right information means being comfortable knowing that you have done the right work to get your customer the best solution that is available. This is always going to be a relevant part of doing business, and it also comes with understanding some mutual concepts of trust and respect in business. And lastly, be resilient if your loan gets knocked back. Now, although you may have followed everything I may have said in this podcast, be it be transparent and provide all the information necessary, you sit down and you fill out all the client fact sheets, you explain fully what the purpose of the loan is for, and you disclose all types of debts and intentions for the money, there is still a possibility that your loan may get knocked back. And the reason why that is because the lender can change their appetite depending on what their loan books look like. So for example, they may have a high number of self-employed loans, and given this period of whatever it may be, given the high number of business shutdowns over this period, some lenders may feel a little bit uncomfortable taking on more SME clients, knowing that their businesses are now closing. Like I mentioned before, there's a matter of storytelling and loans being assessed on a case-by-case basis. Similarly, you may have a security that in the application was told to be of a certain value, and the quoted LVR works out through that initial value. However, upon a further valuation report, the property price is now lower than expected, and so the LVR goes up too high for what is considered appropriate or manageable for the borrower. And so in these instances, loans can get not backed. However, the importance of resilience is that there can always be an alternative or a backup plan available to the applicant if they are prepared to not put all their eggs in one basket. And what this means is that they can ask their broker to prepare a backup application, or they can look to go to conditional approvals before committing to purchases, for example. And what this means is borrowers can expect there to be a little bit more time in getting their money, because although they may have been prompt and timely in providing all the information to the broker and submitting the application, the broker and applicant aren't in control of how the loan gets assessed by the lender. Once you submit the application and fill out the forms and provide all the additional details and supporting documents, that's it. Once it's submitted to the lender, it's submitted to the lender, and you have to wait until they come back for a response or ask for a please explain this, and this. And so the best approach to dealing with a loan getting knocked back is firstly looking back over the application, so brokers and applicants that would apply to, but also understanding what led to that initial assessment to send the loan to that lender. So it may be that a recent change happened in policy, which prevented the loan from going through, which is totally possible. Or it could be that in the first place there was just a piece of information that was overlooked that related to, say, servicing or income or expenses and HEMS that affected the attractiveness of the application. And so knowing these details, and in some instances the lender will explain what led the deal to fall through, and with this feedback, this then allows you to reassess your options, go back to the drawing board and start again. It doesn't mean that the whole situation's over, and that's why being resilient is important, because in some cases, for tricky scenarios, and can be just a matter of being in the market at the right time, rather than trying to break your way into the market without there being really any market for what you're trying to do. And I think for some people, not really for vanilla type of deals, but for some loans that involve, say, construction and pre-sales and developments and things like that, this can be a tricky area to navigate, because although everything may stack up, not everything is as clear-cut as one may wish for. And so the role of the broker is really there to provide that assistance and salvaging, so to speak, of the deal, and hopefully this can lead to a more successful outcome. And on that note, that concludes this episode of the Cost of Carry podcast. I hope you all enjoyed it, and I look forward to speaking to you in the next episode.